very sharply in trade. But Shiv Sehgal of Nuvama is joining us now to talk more about markets. Shiv, thanks very much for your time. Good afternoon. I want to
Hi.
understand the structure of the emerging market and India in particular from you. Given the way flows have turned very conducive, rate hike talk no longer is impacting global sentiment. It's more to do with debt ceiling. How are you looking at the way Indian markets are set up right now?
Well, thanks, Ajay. Thanks for having me. I think we are at a very precarious time. A lot of interesting stuff going on. If you just look back 2 months back in March, we had the U.S. banking scare. There was a mounting stress from the Financial Times that you keep hearing in the commercial real estate property market in the U.S. There is definitely a lot of growing evidence of credit scarcity. But at the same time, we have Nasdaq making all-time highs, or at least back to almost April highs of last year. So there is a conflict going on between investor fears and uncertainty regarding the U.S. economy, which the bond market is relating to. And if you look at the 2-year Treasury yields, we peaked at almost like 5% in March 8th, and then we hit a low of almost like 3.8% at the peak of the regional banking crisis in the U.S. And if you look at where we are today, if I look at U.S. 2-year yields, we are around 4.3%. So I guess, what the market is suggesting is the Fed is likely to pause from further increases in policy rate. And if I look at the Fed fund futures, that market is suggesting almost a 52% probability of a November rate cut of 25 bips and another 50% probability of another 25 bips cut by December, which is actually helping the emerging markets. And we are seeing, foreigners turn buyers in Indian markets for the last almost 4 or 5 weeks. So it seems to me that the bond market is telling us that the 2-year yields have made an important cyclical top in March. And if you look at the history, I mean, predominantly we have looked at the 2-year yields as long as they remain below the Fed funds rate, the greater the lag effects on the US economy of the Fed's restrictive policy, and henceforth the more aggressive Fed's eventual policy shift towards easing, which is what markets are pricing in at the moment. Also, it is also worth noting to indicate that from a macroeconomic point of view, all the leading economic indicators have been declining in the US. Actually, the conference board's LEI has now declined for 13 consecutive months. And I was looking at some analysis. The last time we looked at such bearish indicators was almost at the peak of the global financial crisis in March 2009. So there's a tussle where bad news is actually good news because markets are extrapolating that the Fed will pause, liquidity will come back into the system. But at the same time, the narrative in emerging markets is a lot more positive. But if you look at the hedge fund community from a developed market perspective, it's very interesting to note that the S&P 500 net speculative positioning indicates a massive shorts in the system going into this summer debt ceiling event. Now, the debt ceiling event, I mean, you've talked about in your show as well, is a known unknown. The market is aware of the event, but we are unsure of its outcome. If the US Congress fails to reach a consensus on the debt limit, the event will likely cause more volatility soon. Historically, we have seen alarming statements from US Treasury about an impending default, which is all part of the political posturing, and the limit is usually raised in the 11th hour. Historically, we have always seen that. But let's see how it plays out. For me, what is more critical is that in the last 2 months, we have seen the G5 central banks liquidity picking up. So liquidity is projected to go up in the future months, especially in the second half of this year as well. And to me, the pain trade from markets perspective remains up. And I think my view is that we muddle through the summer noise of the debt ceiling and the uptrend continues. And the biggest beneficiary, of course, will be emerging markets. And that, as you just rightly mentioned, we are seeing that much extrapolate that in India as well, where the mid cap and the small cap space last 2 months has come back very strongly.
Shiv, if one were to take a 1 to 2 year kind of perspective, what kind of structuring would you do to your portfolio, given the fact that when rates usually peak out, there is a good period of outperformance from mid cap, small cap. At the same time, earnings quality of the large cap universe is also not that bad. Barring a few infy like names, many have actually done very well, better than what Street was actually estimating on earnings front. How would you structure a portfolio to play 12 to 24 months?
So great question, Ajay. I think, the result season this year has been pretty much in line and encouraging. our key takeaways have been that the domestic demand in India seems to be far better than the export demand. I think this trend will likely continue into the foreseeable future. I think the China reopening trade has not really played out from emerging market perspective as way people were anticipating in January 2023. It's been a stop and start situation for China, and as a result of which we are continuing to see a lot more impetus and limelight given to India, and there is a genuine structural shift in foreign investors in terms of India. I think the margin headwinds are receding, and in fact tailwinds are coming through for India for FY24 as well as for the next 18 to 24 months. I think the margins could see some upside given that commodity prices are remaining soft, given that the China reopening has kind of been a soft patch as well. In terms of financial earnings, we could see some moderation as margins, in my mind, have likely peaked out. However, if you look at most of the commentary coming from both private and PSU banks, they seem very confident on credit demand, which augurs very well for rural India as well, given monsoon season is just around us. And I think the biggest beneficiary has been the industrial companies continue to post strong quarter with robust order inflow growth. So overall, earnings season seems to be that we are favoring the domestic demand-led companies and sectors, while exporters, I think from a global perspective, will continue to face headwinds at least for the next 1 or 2 quarters. But I see that emerging and changing as we enter the last leg of financial 24. In terms of sectors, you rightly said, apart from infill, the IT space in India has been consolidating for almost a couple of months. We are seeing momentum, flows, and liquidity coming back into that sector. The mid-cap space has done really well. And I do believe that even real estate, in my mind, cannot be ignored in India. Despite the increase in interest rates, I remain of the view that it would be a mistake to be underweight this sector and the home decor system as well, the segment as well. India's growth story remains very much intact, and I remain very bullish. From the domestic demand-led impetus that we are seeing. Now, one more key takeaway for me is what we are seeing in the infrastructure spend. I think we are probably going to see a lot more capex spend by the government, and that is percolating down into private companies as well. And that, to me, remains a very big beneficiary over the next 18 to 24 months.
Okay, one last question. What universe in the market are you most bullish on compared on parameters like risk reward, valuations versus the earnings growth they offer? Is it the mid cap, small cap, or small to large, or the large cap universe? Oops, I think we lost the connection. Yeah, Shiv, go ahead.
So yeah, I just got the first part of your question. I think you were asking me which segment I prefer more, large caps or mid caps, and which segments are looking better. As I said, India is in the midst of a major infrastructure upgrade. The Indian government intends to invest almost 1.4 trillion in infrastructure over the next 5 years. I think any ancillary that is a derivative of the infrastructure spend, whether it is railways, defense, the cement, the domestic auto demand, all these sectors will do very well. Another theme that's kind of emerging in this year is the fact that if you look at, and in the developed markets, we had Nasdaq, tech, growth, all kind of underperforming a lot in 2022. And the flip side of that, as this year in 2023 has emerged, we are seeing all these kind of laggards turn leaders. In India, I'm seeing a similar trend in terms of the laggards that were last year have turned very positive. We have autos, FMGG, industrials, which 2022 were doing well, but in 2023 are even doing better. Whereas on the flip side, we have seen the large outperformance of PSU banks, the power sector, kind of take a backseat in India at the moment. But I think overall, as you rightly said, I think India is an alpha market for me in FY24. I think some of the gems that we are talking about and finding in the mid-cap space and small-cap space, which has probably been a consolidation phase since the peak in Jan 2018, that's the space that I'm the most excited about, and I think that will be multi-baggers in India in the next foreseeable future there.
All right, Shiv, we'll let you go on that one. Thanks so much for joining us on the show today. Before we